Understanding the numbers, how to know if a deal cash flows. Welcome to Module 3. Now that you know how to pick a strong market, let's talk about the next skill that separates the great investors from the guessers, and that's knowing the numbers. Because at the end of the day, it doesn't matter how great the city is if the property itself doesn't produce a positive income. So we really need both of these things. A property can drain you both ways, and I know this from experience. So the math tells the truth every time. In part one of this module, I'll tell you why cash flow matters more than anything. When I look at a property, I don't just ask, will it go up in value? Although that does matter, which is what we did in the first module there, looking at markets and growth rates. But I need to ask, will it pay me sustainably every month? That's cash flow. The money that's left after you've paid all the bills, the mortgage, the taxes, insurance, the maintenance, the property manager. Cash flow is what creates stability and freedom. If you're earning positive cash flow, you're in control and you can't be forced to sell, which many people do get forced to sell in bust times, right? Because they didn't have the cash flow to support the deal. So if you're negative, you're at the mercy of the market. The 5 numbers that drive every deal, let's go through those. So every property analysis comes down to these 5 inputs. We got our purchase price, the gross monthly rent, we got the operating expenses, which includes all those things like taxes, insurance, maintenance, vacancy, all that stuff. We're going to go through that more in detail at the end when I'm going to show you a spreadsheet that we can use for this. We got our mortgage payment, and then the last number we're looking at is the actual net cash flow, which we do want to get a percentage on that. So if you can get those 5 numbers right, you can do a basic starter evaluation of any deal anywhere in North America in under 5 minutes. Here's how it works. The annual gross rents have to equal at least 7% of the property's purchase price to make sure that it will be in the range of potentiality having profit. I have to figure this out. First, I have to figure out all the foreseeable rents or current rents if it's already being rented or has it been rented in the past. You can call local realtors. You can go online to figure out what's going on with rental markets in that area. It's good to call the local property management companies. Or you can just go and ask the listing agent directly. Sometimes they know, right? If I'm online looking at properties, I'll just call the realtor on there and just ask that question directly. And you could ask ChatGPT. It can help with this kind of stuff. But that first number you got to get is, what the property's purchase price is or the offer price they have online. You can kind of give a guesstimate of what you think you can get the property for. And then I want to know what I could rent this property for. So that's the threshold I use to basically find out if it's going to be in the zone of potentiality. If it doesn't come close to the 7% mark, I kind of move on. That's, it's unlikely to be worth investigating further. Also, I'm assuming that we're getting a cash flow positive property with a 25% down payment on the smaller deals and maybe a 30% down payment on the larger multifamily deals, right? Larger cap deals. So let's run an example here so you know what I'm talking about more clearly. So you got a property, let's say that's priced at $400,000. We want that to be a 7% rental income on that $400,000, which would be equal to roughly $28,000 a year in rent, right? 7% times $400,000, $28,000 a year in rent. So if you divide that by 12 months, that's $2,333 a month is what I'm looking for to make a $400,000 acquisition make sense. So if it's only pulling in $1,900 a month, like I check in and I go talk to the real estate agent or I talk to the local property manager and it's only $1,900, that's a red flag. It's possible that it's undervalued, like the rental income is low, which would be an opportunity, but that's what we got to check in. What is the current market rent for this property if it was rented at the correct rate, right? If it's outside of the cash flow, it's likely just a negative cash flow property, meaning every month I need to deposit more money to keep the deal afloat after rent's been collected. And really, how many of these do you want to own in your portfolio? And the answer is none. You really don't want any of these in your portfolio. So the rule is simple, but it will save you a ton of time and help you avoid markets where the numbers just don't work, right? I'm going to give you a real world example here though, with my first property, which I bought in Alberta, Canada. So I bought the property for $210,000. Monthly rent was $1,400, right? Annual rent. If you do 1,400 times 12, you get your annual rent, which is $16,800. Now you take $16,800 divided by the property's purchase price or the amount that you think you can get the property for. And if you do that division, 16,800 divided by 210,000, you get an 8% annual rent ratio, or a cash flow zone. That's solidly inside the cash flow zone. So after expenses, property management, and a 2.89% mortgage, that property still paid me around just over $230 a month, I think, in positive cash flow. So you always need to factor in as well, like a 7 to 8% property management fee, even if you're self-managing. And, you need to pay yourself if you are choosing to self-manage, because in the future you may or may not want to keep managing. And that's what a healthy deal feels like, right? After all expenses, including property management, it's still got a positive cash flow, and it pays you from day one when you close, and it covers everything. So we can do a full analysis on that particular property in a second here. But once a deal passes that 7% rule, which we'll know pretty quick within minutes, then we can go deeper. So we'll jump onto the screen share here, and you can kind of see a basic overview. So in my more advanced deal analyzer, right, I started with I got all my steps. There's 8 steps, but step 1 was we did the growth rate of the market. Once we found a market that's got a good growth rate, we're going to go and look for cash flow deals within that market. So if I skip over here, I can fill this in. This sheet here gives us a basic overview that you can fill in, just fill in the yellow tabs, and you can get your see if it's going to be a good deal. So let's just say this property was listed for $220. I offer $200, and then I get a property accepted at $210. That would be 8%, which is right in my cash flow zone, right? I'm looking between 7 and 10%. And so we can keep going. The land transfer tax on this deal is going to be $2,200. I'm going to have a $2,500 staying power fund. Let's just say that goes into my checking account. I got legal fees. I have a little bit inspection fee. I got a little bit of renovation, let's say, just some basic repairs. And then I got my down payment at 25%. So my purchase price to close on this deal, my initial investment is going to be $60,350, right? Mortgage is going to be 75% of that purchase price, that $210,000 up here. That gives us a mortgage of $157,000. 2.89% was the interest rates back then, 25 years. And so my mortgage payment is going to come out to about $740, right? So if you go over here now, when we go to our actual income statement, where we get the income, which is $1,400 a month, we have one unit renting for $1,400. We take off about 3% for bad debt or vacancy. I think in this market, though, at the time, it was like 2%. So I'm not going to take off too much, but you could be conservative with 3%, let's say. Then that gives me my effective gross income is what we call it. So after the vacancy allowance has been taken off, I can expect $1,358. So an occupancy of 97%. My taxes, I think at the time when we closed, was $1,150. So that's the monthly. I had my insurance costs per month. I had my condo fees every month. This was a brand new property, this particular one I bought. So it had very low everything. Property management at 6%. I've got a repair fund at 5%, which is, for a brand new property is also kind of not necessary. But even with that being said, that gives me a net operating income. My income after my expenses for operating the property and before mortgage is called my net operating income, right? So now you can get the yearly net operating income minus my mortgage. My mortgage is going to be the $740 times 12. And that's going to be $8,880. So net operating income minus my mortgage payment gives me my cash flow. So I'm going to have a cash flow of $2,973 a year. If you divide this amount by my initial investment, which is $60,000, that gives me my return on cash, my cash return. So my cash return on this particular deal was 4.9% cash flow, right? That gives me every single month, I have $248 above and beyond all expenses and payments, including my mortgage. If I was paid off on this mortgage, I'd bring in $987. But that is how we kind of get the basic I can get all these numbers pretty fast, right? That's the beauty of this. Now, let's take a minute here also just touch on some of the common investor traps that I see that you need to avoid. One is ignoring or forgetting expenses or under budgeting repairs, vacancies, not including your property management fees, missing your management renovation fees. Like, basically just skipping any of these costs right on the screen here, just skipping through them and trying to improve your numbers by just neglecting things. That's probably the biggest thing that people screw up, is you really got to make sure you're conservative with this. And that means you're probably gonna have to look at hundreds of properties to find the best ones, right? You need that exposure. You got to look at lots of them. That's why when you can get through this process quickly and maybe go through 10, 15 deals a day, you're going to get a lot more exposure to like, what are the good ones? Where does it just not work? Some markets just don't work at all. No market, but like, it's a growing market, but there just are no cash flow properties in that market. And that's just the way it is. So, not putting that margin of safety in and not getting the correct cash flow number or expenses into your analysis. That's the biggest mistake I see. Another one is straight up just falling in love with a property. So if the numbers don't work, you have to walk away. Remember, you're building a business, so you're not buying a dream home. Try not to confuse the two of these things. Personally, I think it's good to feel the properties you buy are beautiful and that you would want to live in them, but that certainly is not the primary consideration, right? You got to buy these as investments that can pay for themselves, so that you can actually relax and sleep, because you're going to own these things for like 10, 15 years, some of them, right? So to wrap things up here, do a few of these per day, and after a week, you're going to start being able to spot some of these deals. Just to recap, start with your cash flow zone rule. Annual rent should be 7% of the purchase price. Run the 5 key numbers to confirm cash flow. Only buy deals that pay profits every month from day one. And in the next module, we're going to talk about how to finance these deals, the differences between bank loans, private lenders, and creative structures that help you grow even when you don't have a massive down payment. So we'll see you in the next one, cover financing.